First off, I'd like to welcome everybody. I'm Don Johnston, partner at Tax Services Group. This is Ryan Fronius. You want to introduce yourself, please?
I'm Ryan Fronius. I'm a senior manager in the Tax Services Group, and I was forced to wear this sweater, and it's very hot.
Yeah, as soon as I found out we were doing the Mr. Rogers, my first thought was, I'm wearing a sweater. I'm wearing a red sweater. I let Ryan pick out his own color. And I wanted to change my shoes on stage. My partners absolutely said, no way. But I tried. So we have 50 minutes to talk about the One Big Beautiful Bill. And one thing I will say, we had our topics and the name of our seminar today picked out way before the One Big Beautiful Bill Act came out. We knew what how we were going to structure this back in March, April timeframe. So there is no tie-in to our day with the actual One Big Beautiful Bill Act. So just want to make that clear. They followed us, we didn't follow them. So One Big Beautiful Bill is just a absolutely ginormous tax bill. This is the biggest tax bill since the 1986 Tax Reform Act. That was close to 40 years ago, passed by Ronald Reagan. There's a lot in this bill. This bill was over 900 pages long. Now, every time I see a statistic like that, it makes me crack up, because doesn't the number of pages depend upon the font? Like on a day where, if I forget my glasses, that 900 pages is like 10,000 pages if I've got to increase the font. So let's just say it was a big bill. There is so much involved in that. It's a big bill when the summary book is 500 pages. And it is. There's so much. Unfortunately, we can't talk about a lot of the things that are in this bill because, first off, a lot of them are so far outside of the scope of what we do on a daily basis. In reality, the tax code is ridiculously long. It's ridiculously complex. We probably cover 10, maybe 20% in total of what we do on a daily basis. Our clients are probably involved in 10, maybe 20% of what's involved in the tax code. It is just so voluminous. And there's things in there about, rural farmers and credits and just so many things we don't deal with. But there is a lot that we deal with, and what we do, we try to really dig into the details and understand. So that's that's important, because the majority, our clients want us to know the deep details. So we work really hard to know the deep details. So we're going to cover a couple different areas today. We're going to cover individual tax changes and extensions and things like that. Ryan's going to cover those. I'm going to cover the business side. Unfortunately, it's such a small piece of this entire tax bill, but we're going to try to cover and we'll try to go into depth. And what the topics that we've selected to specifically talk about are those that our clients really are dealing with. Whether it's business issues with Section 174, bonus depreciation, all that stuff that we see on a daily basis. Ryan's going to talk about the individual things. Another thing Ryan's going to talk about and spend a little bit of time on is a thing called the Trump tax accounts, or the Trump savings accounts, which he'll dig into. The reason we're spending a little bit more time on that is because who attended our GYF tax talk? Anybody who's attending put your hands up. Oh, we got a lot of people. So, yeah. So we have started a thing on a quarterly basis we call GYF Tax Talk. We provide CPE, which is, we know that gets you in the door. We provide CPE, and we're going to spend an hour every quarter just talking about stuff of relevance. And we talked about the One Big Beautiful Bill on our first GYF Tax Talk. Second one, we kind of added to that and talked about some things in the One Big Beautiful Bill. So we're going to keep doing those tax talks because people attend, and it gives us kind of an area or a time where we can get on and just talk about stuff that's relevant and stuff that's affecting our clients. After 35 years of doing this and being in tax for 35 years, there are so many stories I can tell you about, so many things that we've done, things that we should have done, IRS issues, state tax issues, things I wish we did better, things that we've done really well, and we continue to get better at. But the One Big Beautiful Bill, it's huge. Sometimes it's referred to as One Big Beautiful Bill, or the Big Beautiful Bill, or HR1 technically is kind of the name for it. I kind of have my own acronym that I've set up for it. It's the CTJFAA. Does anybody know what that stands for? CTJFAA. It's the Creating Tax Jobs for America's Act. It's because in reality, anytime a big bill like this comes out, I mean, there's just a flood of experts, a flood of tax professionals, new things coming out as far as how we can serve our clients. And there are boutique firms that come up and they do their special thing with respect to serving new areas of tax law. So those things are kind of in process. And I would say we've had 2 tax bills in the last 8 years, the last big one being in 2017 with the Tax Cuts and Jobs Act, and then this big one. And I will say since 2017, we've doubled the size of our tax group. It's crazy. There's just so much out there and so much for us to do. There's so many things that keep me up at night. IRS is one of the main things, not because I'm afraid of the IRS or I'm concerned when one of my clients gets audited by the IRS. It's because of the state of the IRS and how upside down it is on a daily basis. Whether we need to call them and talk to them, which is almost impossible, whether they send my client a $300,000 tax notice, or whether I get one of those letters that says, greetings, we're going to do an audit. Anytime I get that audit letter, greetings, we're going to do an audit, I know it's a 2-year project, at least a 2-year project. Now, I want billable hours like everybody else. I don't want them that way because it's painful. It is very painful. And those of you who have dealt with IRS audits, you absolutely know how painful it is. So with that said, with that as the introduction, but like I said, I'm not worried, I'm not afraid of the IRS. The whole process is what keeps me up at night because it's painful. So with that said, the way we're going to do this, but Ryan's going to handle the individual side, I'm going to handle the business side. One of the most important things of this bill, one of the things that makes me happy, whether I like the policy or whether I like the changes or not, one of the things that makes me happy about this bill is many of these changes are permanent, which means that I don't have to worry about them changing in 2 or 3 years or sunsetting in 2 or 3 years. The 2017 Tax Act, the majority of it sunset, and that sunset was supposed to be at the end of 2024. Anytime the tax law is going to revert, it's a nightmare for us from a planning perspective. From a state planning perspective, it's a nightmare when you don't know what the lifetime exemption is because it's supposed to expire. So much of this bill is important because of the permanency. So we know, unless there's a change in Congress, which is possible, but we know at least for the next 3 or 4 years, it should be where we are now. So that's very important, and as a tax professional, makes me happy, whether I like the policies or not. It makes me happy that I know what the law is going to be until there's a change. So I'm going to let Ryan take over, talk about the individual tax changes, then I'll jump in with business tax changes at that point.
Before I get started, you just had to say that you're not afraid of the IRS. Each of us are going to get 3 notices saying that we have an IRS audit when we get back, so thank you. As Dawn mentioned, I'm going to start off with the individual tax provisions, and then he'll get onto the business side of this. I think he also said these include permanent and temporary differences, and I think we've done a decent job of identifying that throughout the presentation. And a lot of these really are just extensions of the former 2017 TCJA. I know Dawn likes to pronounce that a little bit differently, but I'll get kicked off the stage if I ask him to pronounce it. Yeah, so I guess starting off, how do you work this thing? Okay, individual tax rates, pretty simple. They permanently extended the lower TCJA rates for tax years after 2025. If you recall, before mainly the top tax rate for individuals was at 39.6% for a number of years. The TCJA in 2017 decreased that to 37%. All this act did was keep that at 37% permanently. And then also the estate and gift tax exemption for years beginning after 2025, the exclusions permanently increased to 15 million, and that's indexed for inflation after 2026. Without the passage of this act, this was previously set to revert to around $5 million adjusted for inflation, so this obviously was a good benefit there. The standard deduction, this permanently extended further increased the larger standard deduction. Again, the standard deduction used to be about half of what it is now, and this act permanently saved that increase as well. You'll see right here, single married filing separately, that's about $15,000 head of household, $23,625, and married filing joint $31,500. So this deduction, as many of you know, is you take the standard or you itemize your deduction. So this is a nice benefit to have a higher deduction there. Also, this is new, the enhanced deduction for seniors for and this one's temporary, so it's only for tax years 2025 through 2028, so you only have it for a couple of years. It's a new $6,000 deduction for taxpayers age 65 and up, and this is phased out, so anyone at that age level will get this deduction, but a phase out does begin when your AGI hits those thresholds that are on the slide. So once single taxpayers, once it's over 75,000, that will start phasing out. And married filing joint over 150,000, that'll start phasing out. These next few ones that I'm going to talk about, these, you've probably heard a lot of these buzz terms in the news whenever Trump was running for office. The no tax on tips, we'll talk about no tax on overtime, and then the car loan interest deduction. But no tax on tips, a lot of you have heard about that. This is temporary only for tax years 2025 through 2028. And this is applicable for taxpayers whether or not you itemize. So if you take the standard deduction or if you itemize your deductions on Schedule A, you can still get this deduction. The deduction is up to $25,000 for what is called, for your qualified tips. And right here, it'll give you the definition of what qualified tips are. It's any cash tip received in an occupation that customarily and regularly received tips on or before 12/31/2024. So any business that you can think of that, gets tips regularly, that's what businesses qualify for this. And actually, the IRS issued proposed regs that include a list of those qualifying occupations. I think they're still waiting on commentary to edit that and finalize it, if I'm not mistaken. But should be out pretty shortly. And there is a phase out for this. So even though it's called no tax on tips 1, it's limited to $25,000 and it's phased out. So taxpayers might not get that full benefit whether or not, depending on what their income levels are. And the last thing with that, the no tax on the tips will be required to be reported on Form W-2, so employers will have to report that for taxpayers to understand what that tip amount is. No tax on overtime. This is similar, so also temporary, only for tax years 2025 through 2028, and taxpayers can take this whether or not they itemize. This deduction is a little less, so it's $12,500, or if you're married filing joint, $25,000. And what's important, it sounds like, okay, anyone that works overtime, CPAs work a lot of overtime, a lot of people in this room work overtime, but it's not for everybody that's working overtime. It's only for qualified overtime compensation under the Fair Labor Standards Act. And the key there is it's only for the amount that an employee is paid in excess of their regular pay rate. And that will also need to be reported on Form W-2. And again, there's a phase out. It's actually, that deduction is reduced by $100 for each $1,000 by which their modified AGI exceeds $150,000 or $300,000 for married filing joint. And yeah. But what I was going to say is the no tax on overtime and the tips, while they're required to be reported on Form W-2, the IRS recently issued a notice saying that there's going to be some transition relief there. They recognize this is new. Employers have to get up to speed with the reporting requirements. So if it's not reported correctly on the W-2 for 2025, there will be some relief, and they say they're not going to issue any penalties. So got that going for us.
Yeah, I mean, this is one of those situations where you need to read the fine print, right? Because, it just says no tax on overtime. You think, okay, if I work 41 hours, that additional hour doesn't get taxed. But that's not the case. It's the additional, the time and a half piece, the half piece over the normal hourly rate is what doesn't get taxed. So if you're making 20 bucks an hour and you work overtime and you get time and a half, so you're making 30 bucks an hour, only that additional $10 is not subject to tax, which is kind of like, okay, you got to read the fine print, because if you don't read the fine print, that's completely confusing, right?
Yes.
At least it was confusing to me.
It's confusing to me as well, Don.
Good, we're on the same
But now
page.
we understand. All right. Car loan interest deduction. So in the previous presentation, they said cost of pretty much everything is up. One of those being new vehicles, those are definitely up. So this can be a nice deduction for a lot of people. Again, it's temporary, only for tax years 2025 through 2028. And like the other deductions, you can take this whether or not you itemize your deductions. This is up to $10,000 of interest paid on new car loans. The key being, it's only for new cars, it's not for used cars. And the vehicle has to be, the final car assembly must occur in the United States. So it can't be for foreign vehicles. They're trying to help out the auto industry, we think. So they're really looking to help US-made vehicles. Which doesn't make sense, because if you're trying to help the auto industry, we've talked about this, why not help out everybody? Why have a phase out? Why limit it to people based on their income levels? But similar to the other provisions, that's just how it works. Once your income's over 100,000 single, that starts to phase out. And once you're over 200,000 married filing jointly, that starts to phase out. But this is new. Completely new. I don't think we've seen something like this before. So if you're in the market for a new vehicle, definitely keep this in mind. The SALT deduction cap. So this has been big over the past several years. This is temporary, but if you recall, historically before the 2017 tax cuts, there was no cap specific to the SALT deduction, the state and local taxes. These are things like your state withholdings from your W-2, non-resident withholdings from pass-through entity property taxes, et cetera. In 2017, the tax cuts capped that at $10,000, which was a huge hit to a lot of taxpayers, especially taxpayers living in high-tax states such as California, New York, New Jersey. You know, they're paying all these taxes to these states because it's just expensive to live there. Before, they were able to get a full deduction for that, so at least that helped from a tax standpoint. But then this $10,000 cap came into play, and it limited people a lot. Some people were paying $50,000, $60,000, $70,000 in taxes, and the top rate of 39.6 or even 37%. That's a big benefit to be able to deduct that. However, $10,000, that limited them significantly. Under this act, they're now increasing that cap to $40,000. So it was at $10,000, now it's at $40,000. Still a limitation, but it's a little bit better, a little bit more of a benefit. And that number will be indexed for inflation over the years. However, there is a phase out. So even though they're increasing the cap to $40,000, it's still going to be reduced, and it says it on here, reduced by 30% of excess modified AGI over $500,000. But it can't be reduced below $10,000. So at worst, you're still going to have that $10,000 cap. It's not going to limit it to $1,000. So again, it's a good benefit, but a lot of high income earners will still be subject to a further limit less than that $40,000. This will revert to $10,000 after 2029, so once that time comes, it'll go back to the normal TCJA limit of $10,000. Another thing that was in this related to the SALT deduction was the fact that the beautiful bill preserved the benefit of the pass-through entity tax elections. And for those of you that aren't familiar with what those are, basically these were put into place as part of it was a way to bypass the $10,000 SALT cap limit, because previously, perfect example is a pass-through entity, so a partnership or an S corporation. They're not a tax-paying entity. However, if they're operating in a state and they have non-residents there, then they're required to withhold tax in a lot of situations on behalf of those non-resident owners. Normally, that is considered, that tax that is required to be withheld, that is considered a tax that is an owner-level tax, so it's not a business-level tax. That tax that is paid, even though it's paid by the partnership, it is subject to the $10,000 limit. So in those situations where those pass-through entities were paying all those taxes, at least taxpayers were able to benefit by deducting that before the $10,000 limit. The $10,000 limit comes into play, not as likely to be able to deduct those. The PTET elections were put into place to bypass that, where there's an election made at the entity level that says the tax that is paid by the entity is now a business level expense. So instead of that passing through the owners and being an owner level deduction, it's now basically an ordinary deduction against taxable income of the pass-through entity that passes through to those owners and is fully deductible. In other words, it gets around that $10,000 limit. Not every state has implemented that. I don't believe Pennsylvania has, but a lot of states have done that. It has been beneficial, but what this bill did is it basically preserved that benefit, so it is still there. Obviously, the cap is higher at 40,000 versus 10, so it might not come into play as much, but it's still there. It's still very beneficial and something to be considering.
In reality, a lot of us expected the IRS to go completely opposite of this and say you can't do this anymore. But the way they did it, they kind of signed off on it and said, okay, we're okay with that. It was very surprising that they didn't squish this like a bug, to be honest with you. And the fact that they kind of acquiesced on it is very surprising. All right. As we mentioned, there's a lot of provisions. There's other related provisions that we think will be impacting our clients here that we have listed. We won't get into detail on these, but you can see the mortgage interest deduction. That basically made the cap, the $750,000 cap on acquisition indebtedness permanent. Casualty loss deduction, that was limited to federally declared disasters. That was made permanent, but it also expanded it to include state declared disasters. P's limitations, these were old limitations on your Schedule A deductions. These were suspended in 2018 to 2025. These limitations aren't back, but there are new limitations that are a little bit different on your itemized deductions. Child tax credit, this was permanently extended and was also increased from $2,000 to $2,200. 529 plans, these were brought in to include more qualifying expenses, and there was a nice increase on those from, I think, $10,000 to $20,000. And then Trump accounts. So we'll talk a little bit more about these in detail, and then I think after that we'll get into the business side of things. But the Trump accounts, these are new, and we've gotten a lot of questions on these. It's basically like an IRA, and it's a savings account for children. It's like an IRA, and you can contribute to these before the age of 18. I'll say there's three sets of contributions that are involved in these. First, the $5,000 annual contribution limit. This is the normal limit, similar to $7,000, whatever the limit is for IRAs right now. That's how much can be contributed per year, and this is per account and per year. So if my son, someone wants to contribute to his account, 20 different people can contribute, grandma, friend, uncles, cousins, whatever. They can contribute, but the maximum amount that can be contributed to each person is $5,000 per year. There's another type, the $1,000 government-funded pilot program. This is only for children born between 2025 and 2028. Any child born before that age is not eligible for this, but anyone born during that time is eligible for this. The government, it's essentially free money. They'll give $1,000 into that Trump account, but the parent or legal guardian does need to make an election for that. So make sure you're paying attention to that. Definitely get that set up. It's essentially free money. You don't have to do much to get that. Other than your taxes will probably get up to fund that later on. And then the $2,500 annual employer contribution limit. So employers can actually make a contribution to a child's Trump account as well. They can contribute up to $2,500. And this does count towards the $5,000 annual limit that I just mentioned. So if an employer contributes $2,500 and someone's grandma wants to contribute, they can only contribute up to an additional $2,500. As far as contributions and distributions go, you cannot contribute until after at July 4th, 2026. So you cannot contribute until a year after the enactment of this act.
And then the contributions must be made before the age 18. These are not considered for other IRA limits. So if someone has a Roth IRA or a regular IRA, this is in addition to it. So you can have both of them, and just because you put $5,000 into this doesn't impact what you can contribute to another IRA. Any exempt contributions, we won't get into those, but this does include the $1,000 government-funded pilot program and then certain rollover contributions. These do not count towards the $5,000 annual limit, so those can be made in addition to those. For distributions, you can't contribute, or you cannot pull out money before the child turns 18. So any contributions have to be made before the age of 18, and then once they're 18, you can start distributing out of that. Any earnings are taxable. However, any funds that are distributed that relate to previously made after-tax contributions, those are non-taxable, but any earnings will be taxable on those. And with that, I'll hand it over to Dawn for the business side.
Yeah, just a comment on the Trump accounts. They're expecting that somewhere between 20 and 40% of the people who qualify, 20 to 40% of the parents who have children that qualify for this will never sign up for this handout. Seriously, I mean, if you have, looking around the room, we probably don't have anybody here that qualify for their children, no offense. But for grandkids, make sure your kids are signing your grandkids up for this handout. It's free money, but you have to sign up for it. They're not going to put $1,000 into the account for your grandchild or your child unless you actually go sign up for it. And the numbers will be staggering as far as how many people really do not sign up for that, because they don't know about it. You know, how many people really understand this unless you're paying attention to it. The number of people who do their own returns and, you know, basically just do it on an online software package is pretty high. So just make sure that your family members are actually signing up for this. I can't say enough about the utilization of putting money in your kids' IRAs if they're working, or putting money in these types of accounts, because we all know how money grows and the power of compounding. And, you know, it's just really important. 529 plans, incredibly important for your kids. If you have young kids, he's got 2 young kids. I think we're starting a GoFundMe account for your IRA for your kids, right? For the 529?
Yes, absolutely.
So you can sign up for that afterwards. But anybody who has young kids, as soon as the day the kid is born, you should open a 529 plan and start putting $100 a month into it, because it really, really, really does pay off, especially when the market does well. And basically you have 18 years of compounded growth. So do it for your grandkids, do it for your kids, and, you know, if you have family, friends or something like that, and you have extra money, start putting money into 529 accounts for kids, so you know, so they have a better future and have a way to pay for school. As we know, college costs are not going down anytime soon. Okay, business provisions, and like we said earlier, we can't possibly cover everything, but, you know, the couple of really important things here. The first one is the research and experimental expenditures. So this issue, I mean, where's my soapbox? I thought we were going to bring a soapbox for me.
You were going to bring it out.
So let me stand in my soapbox area. So with the 2017 Tax Cuts and Jobs Act, to help pay for that bill, they changed the research and experimental expenditure rules, but they didn't become effective until 2022. So in 2022, when this thing actually kicked in, what the rule change was that any company that's doing research and development or research and experimental, and they're spending money, you have to capitalize all of those costs. So for example, if I spend $1 million doing research, under the old law up until 2022, I just expense those amounts. Starting in 2022, there's a requirement to capitalize all of those costs in accordance with Section 174. And basically what it said was almost, I mean, there's so many things that qualify as R&D that didn't qualify. You wouldn't think that qualified. For example, if you were the controller and you spent 1 hour a month thinking about R&D costs, that got capitalized. It's similar to Section 263A inventory, but it's completely ridiculous. So this kicked in, and everybody thought in 2022, when this kicked in, that this is going to be reversed because it makes no sense. And it's not good for the country that these R&D costs have to be capitalized. The new rule was you capitalize, in my example, you capitalize the $1 million, you get to expense it or amortize it over basically 6 years, 5.5 years. So you spend $1 million and you don't get to expense it. We had so many clients in 2022 that had huge add backs. I had one particular client that does a lot of R&D work, and they had a $10 million add back each year between 22, 23, and 24. Now, we being the CPA community, the tax professionals, we all thought that this was going to be changed and it was just a matter of time. We extended so many returns in 2022 when they were due because we expected the law to change before September 15th, the extended due date. So we extended the returns hoping that the common sense would come into play and they would change it back. Because both sides of Congress agreed and they were on the same page, it needed to be fixed, but it was not fixed. So we went through 2022 and it never got changed, so all those extended returns got filed. And then going into 2023, we thought the same thing. Both sides expected that it was going to be changed. They knew it was going to be changed, but they didn't get it done. So 2023, we had these big add backs. Go through 2024, same exact thing. Now in 2024, at least there was a glimmer of hope because at some point in 2024, we knew there was going to be a change to administration, and we were hoping that there was going to be a tax bill, and there was. A tax bill finally came through, and it fixed this problem. So going forward, starting with 2025 costs, you no longer have to capitalize these costs. You get to expense them currently. That's a big win for everybody. So anybody who has R&D costs, you should be really happy. You no longer have to keep track of that. It is very interesting, starting back in 2022, how many of these boutique firms popped up that were doing 174 studies. And they were going into companies and say, hey, let me do your 124 study. They charge you $22,000 to do the study, and you'd capitalize $1 million, blah, blah, blah. So that went on and on and on and on. Again, the Creating Tax Jobs for America Act, right? Kind of similar to that. So these boutique firms popped up and they were doing all these 174 studies. It was unbelievable. How many folks in here had somebody do a 174 study for them? Anybody? Yeah, there's probably 10%. Okay, so yeah, I mean, it was a huge cost, but you had to do it because you were worried the IRS comes in and challenges and changes and all that stuff. So this particular area, the R&D, it's made permanent, so we don't have to worry about it going forward. So going forward, we get to expense everything related to R&D. We no longer have to capitalize. Okay, so here's the big bonus. What they said was, yeah, we really screwed up over the last 3 years. So everything you capitalized in the past that you haven't already expensed, we're going to let you expense it now. Holy cow, are you kidding me? Now, this is the best case scenario, right? If you're a taxpayer and you had these costs, it's best case scenario. So, I had costs in 22, 23, and 24. In my one example, I had a client to capitalize $10 million, $10 million, $10 million. They had some amortization for those years. But I go into 2025, and with this tax law change, I get to expense all of those unamortized costs, which is just crazy. It's unbelievable that they're allowing us to do this. Basically, they're telling us, we really screwed up. We should have allowed this before, but we're going to allow it all in 2025. So, once this law came out, we did a lot of, we had a lot of discussions with our clients, and we said, listen, you have unamortized costs of like this one particular client, $15 or $16 million. We're able to deduct all of that in 2025. So it completely changed our planning for 2025. Going into the third quarter, we didn't have to pay any estimates because we had a $15 million tax deduction coming through. So if you're a big corporation, if you're a big company, you have two options. You can, as far as the previously unamortized costs, you can expense it all in 2025, or you can expense half of it in 2025 and half of it in 2026. It's home run, right? That's not a bad answer. Everybody gets caught up. The expected cost in 2025 to the government is $50 billion because it's that big. It's $50 billion, all of these tax deductions. Okay, pretty nice, right? If you're a small business, you have different rules. If you have a small business, it gets even better. If you're small business defined as a company that has 31 million of revenue or lower, and that's a statutory definition of a small business. 31 million is just approximately what the number is. But if you're a small business, you qualify for a small business, you have the option of either expensing all of these costs in 2025 and 25 or 26, or under the Create Tax Jobs for Americans Act, you can go back and amend your returns for 22, 23, and 24. So if I'm a small business and I capitalized $1 million a year for 3 years, I have the option, because of this tax law change, now to go back and amend my 22 return, and I get a $900,000 tax deduction because I amortized $1 million. I capitalized $1 million, took $100,000 of amortization. I have a $900,000 tax deduction going back 3 years. And then I do the same thing for 2023, and I do the same thing for 2024. So if I'm a small business, I can go back and amend returns, right? So we're creating more jobs for tax accountants, which is awesome. So that's an option. And you'd think, okay, that's an obvious choice depending upon the situation, right? I can go back. Well, what you have to do is you have to look at the math. Does the math work? Am I going to get more money back by going back and amending 3 years of returns because I've got to pay the CPAs to do their work because they're worth it? Or do I just run it all through 2025? It depends upon the situation. Not all situations are the same. We're probably 50-50 with our clients that we've looked at this as far as going back and amending. Sometimes it makes sense to go back and amend. Sometimes it doesn't make sense to go back and amend. Depends upon the particular situation. Where it would not make sense is if you have a change in ownership. Let's assume Ryan and I are partners. We're shareholders in the S Corporation. We owned 50% in 22, 23, and 24. On January 1st, 2025, I bought him out. There's no way I'm going back and amending the return so he can get that refund. I'm taking the entire deduction in 2025. I get the benefit, he loses out. Now, fortunately for Ryan, if he was paying attention, he may have put something in the stock purchase agreement that says, hey, if there's some kind of funky tax law and then go back and save money, you got to do that. Most of those stock purchase agreements didn't do that. But we had one that actually did it, where somebody was actually on top of it and said, hey, if anything funky happens with the government, they change the tax laws. But anyway, that actually happens. We had a client to do that. So it's really interesting. This is permanent. And it really matters because the numbers are so big. So I put together just a quick example just to walk through this very quickly. I know it's hard to see the numbers. I apologize for that. So this is what the old law said. And my example here is a company that spends $1 million a year for 22, 23, and 24. Okay? So what they're able to do, this is how they would have expensed that $3 million over that 3 years. You can see for 25, 26, and thereafter, there's like $2.1 million of unamortized costs. That's my tax deduction. I get to deduct that $2.1 million in 25 or 25 and 27, whatever. I get to deduct $2.1 million at some point. Okay? So this is how this would work. If I'm a small business, I can go back and amend. And for 2022, I get a $900,000 tax deduction. In 23, I get a $700,000 tax deduction. And in 2024, I have a $500,000 tax deduction. That equals $2.1 million, which was my unamortized cost. I've done the math quite a few times. The number keeps coming out that if your costs are the same for 3 straight years, the number that is the deduction is basically 2.1 times your annual cost. So in this case, my annual cost was $1 million. So take that times 2.1 million, that's my tax deduction. And the math just keeps working out because it's just simple amortization, taking the deduction. So that's how the math works, at least on my calculator. Again, this is permanent, and it's very important to be thinking about. There are 2 alternatives if you're a large company, a company with over 31 million of revenue. You can deduct the $2.1 million in 2025, or you can deduct that 2.1 over 2 years, which would be 25 and 26. But like I said, it's important to understand the particular situation. You could be in a different tax bracket, but it all depends upon the particular situation. It depends upon, like I said, what the ownership group looks like today versus what it looked like in 22, 23, 24. You're going to have situations where the board of directors is going to say, we definitely want to amend for some particular reason. You have situations where we don't want to amend, but you have to look at the numbers. It's fluctuating. And the last comment I'll make on this Section 174 issue is, you may have a different answer for tax purposes, for state tax purposes than for federal. So in my example of my big company that has a $15 million deduction in 2025, since they're an S corporation, they did not have to make this adjustment to capitalize these costs in prior years. So I've got a $15 million tax deduction for federal purposes that I don't have for state purposes. So I need to be paying attention to that, or I just messed up my entire tax projection for 2025. Okay, that was my soapbox on 174. There's some, it's not super hard. You just have to understand the rules, and you have to think through. Once you know what the answer is, you have to think through as to how best to move forward. Okay, a couple simple things to talk about. Depreciation changes. The 100% bonus depreciation was restored and made permanent. So thank goodness it's permanent. I don't have to remember what bonus depreciation is. Over the last couple of years, it's gone from 100% to 80% to 60% to whatever. I don't want to remember those percentages anymore in what particular year. Now I don't have to. This is the make Don look dumb, smart not dumb rule. Bonus depreciation 100% going forward. Unless the tax law changes, we have bonus depreciation going forward at 100%. Keep in mind, it is in many states, it's a different answer for state purposes. So in that particular situation, if you have a state that doesn't follow bonus depreciation, you might use Section 179 depreciation, which is the last bullet point there. 179 depreciation was also extended. They also expanded and extended Section 179. Again, a permanent change. So this is a tax law change. This was completely new, completely unexpected. They threw this thing in there. It's called qualified production property. So they're allowing in certain situations for you to take bonus depreciation on real property. So if you're a manufacturer, for example, and you build a brand new plant next to the one that you're already using, or you expand your plant. So let's assume you just, your business is booming and you add another plant right next to yours, you expand, and you spend $5 million doing that. Everything that's related to the manufacturing process, or every part of the building that's related to the manufacturing process, you get to take bonus depreciation on. This is, as far as I've been around, and as far as I can remember, this has never been a situation where you can actually take bonus depreciation on real property. I mean, generally this is 39-year property, but under this new rule, you can take bonus depreciation on real property. So, but it has to be manufacturing. So if you add a manufacturing facility, and 10% of it is your accounting office, you don't get to take bonus on that. But for everything else, you get to take bonus depreciation on it. It's got to be manufacturing. Some production qualifies, but for the most part, it's manufacturing. And before you ask, my one client who's in a restaurant business, no, you don't qualify. There's a special rule for food and beverage industries. Where is he? He's back there somewhere. I saw him. But food and beverage doesn't. So if you buy a building, put a restaurant in it, that doesn't qualify. And this is temporary. This isn't a permanent law. And there's a couple things there that tells you that it has to be constructed between January 19th of 2025 before January 1st of 2029 for this to qualify. Eventually, this piece does sunset. Last bullet point is important. The taxpayer who owns the facility but leases it to somebody else does not get to claim the bonus depreciation. You have to own the building to be able to take the bonus depreciation. Section 163, business interest expense. They changed the rules with respect to how much business interest expense you can deduct. It used to be an EBIT calculation. Now it's an EBITDA calculation. So earnings before interest, earnings for interest, taxes, depreciation, and amortization. Basically, what they're allowing you to do now is when you do that calculation, you get to add back your depreciation, which in a lot of cases is a big number. So it's very helpful. I have a lot of clients in private equity who are in private equity invested in companies, and they're very, very, very leveraged in their investments. And we always have 163J limitations on that. This will help a little bit because oftentimes we have a lot of depreciation and amortization because in most situations we purchase assets, so we could base the stuff up on that. So it's this is a nice provision, and this one's made permanent also. Section 199A, the only thing I'll say here is this Section 199A allows small businesses to deduct, take a 20% deduction. This is absolutely ginormous for my partnerships and my S corporations, because it gives them basically 9% or a 20% deduction on their taxable income. This does not qualify for professional firms like CPAs and engineering firms. Specified small businesses don't qualify up to, once they're over a certain limit. But for big companies, I've got clients that qualify for this, and it's a $2-3 million tax deduction. So it is really, really big. And this allows businesses to be more on an even playing field when you compare them to C corporations that are taxed at 21%. So, it never made sense since 2017. It didn't make sense that an S corporation owner would be paying 37%, whereas if they converted to a C corporation, they'd be paying 21%. So this Section 199A kind of cut the tax rate down for smaller businesses. And when I say smaller businesses, there's really no limit. I mean, you could be a $3 billion business and still qualify for this if you're structured the right way. Section 1202, I'm going to ask a quick question here. How many people have 1202 stock? Put your hand up. Is anybody going to put their hand up? Well, that's actually more than I thought. I'm probably seeing 10 out there. I'll bet you there are another 5 people out there who own 1202 stock, and you don't know you own 1202 stock. There are definitely people out there who don't know they own 1202 stock. So what Section 1202 stock is, it's small business stock that you acquired, and when you acquired it, it was the originally issued stock. So let's assume at Christmas in 2005, your brother-in-law talked you into investing $10,000 in some stupid company he was starting. So you invested $10,000, and it was brand new stock. It was a company he started, and that company is now Microsoft. So you thought it was going to be a waste of time because your brother's a meathead, because most of them, brother-in-law is a meathead. So you thought it was going to be a wasted investment, but that company has continued to grow. If that company qualifies as a 1202, qualifies under 1202, can you mute my microphone for 1 second? Thank you. See, the guys are on top of it back there. So if you own 1202 stock, the way the old rules were, and there's still the current rules, the first $10 million of gain on that stock is not taxable. So I invested $10 million, I sell it tomorrow for $50 million. The first $10 million of gain is not taxable under Section 1202. The reason I add this here is because I know there are people in here that have 1202 stock, you just don't know it. So you need to be thinking about that. When you're selling stock of a C corporation, you need to double check and make sure that it's not Section 1202 stock. The new rules under the One Big Beautiful Bill expanded Section 1202. And 1202 has been in the law since 1993. But the rules have become even better, because now up to first $10 million are excludable. Now under the new rule, it's up to first $15 million, and they made it so you didn't have to hold it over 5 years. Under the old rules, you had to hold it for 5 years or more. Under the new rules for future acquisitions, you can still qualify under 1202 if you sell the stock between 3, 4, or 5 years. Okay, just a couple comments, anticipated impact. There are a lot of planning opportunities that come into play because of the One Big Beautiful Bill. Make sure we're paying attention to them, both on the business and the individual side. Section 174, that's the research and development costs. We need to be paying attention to that. If you have R&D costs, make sure you're talking to your tax professional. Make sure you understand what you can and can't do there. There are certainly some huge benefits there. Qualified production property, if you're adding on to your manufacturing facility or a production facility, you may qualify here to be able to depreciate 100% right off the bat. Bonus depreciation, always thinking about bonus depreciation. We have so many clients that spend so much money on capital expenditures because they get to take bonus depreciation. So basically, they just keep expanding their business and not pay tax because they get huge bonus depreciation adjustments. And keep in mind there could be different answers for state purposes as opposed to federal and state. SALT and PTET planning, solid state and local tax. Got to always be thinking about that. The PTET election is a big deal. If you're doing states, if your business is doing states or doing business in multiple states, you should be making the PTET election to the extent possible. Like Ryan said, California, New Jersey, New York. California allows it. I've got a client that's sitting in the room who has significant tax deductions because we make a PTET election in California. When I say significant, we're talking a couple $100,000. That reduces your federal tax. And like I said earlier, it's very surprising that Congress did not take this away. Okay, a couple do's and don'ts. I have 30 seconds. The clock is, I'm at do's and don'ts. Do register for the Trump accounts next year. Don't forget about that. Remember, I talked about it. Don't forget to register for your grandkids or your kids. Don't forget to use 529 plans for your kids. That's easy. Put money in early. It'll help you pay for college at some point in the future. Plan for the R&D deductions. Those numbers are big. Could be big. Don't forget about the PTET. That's the state tax deduction I just talked about. Try to understand how OBBBA affects you. It does affect you. It affects everybody sitting in this room in some way, and it affects your businesses. Make sure you dig into it and understand it. Don't just blow it off. If you are going to blow it off, give me a call and we'll talk through it. Don't ignore the importance of understanding how tax laws affect you and your family. Teach your kids that it is important for them to understand and know how to do their own tax return when they're young. When they can't do it anymore, call me and I can do it for them. Connect with your GYF executive and discuss your tax questions. We're available, we're around, we're out here, we're a phone call away, we're an email away, we're a Teams call away. I assure you, anytime you Teams call me, I will have pants on. Don't miss our next GYF Tax Talk seminar. That's on 12/9. I'm going to moderate a group of 3 professionals. I'm just going to be pelting them with questions, putting them on the spot, and making them feel uncomfortable after Thanksgiving and before Christmas. Don't forget about GYF Tax Talks. We're excited to do them. We can't wait to do the next one. And like I said, we're going to be doing them quarterly. When you do your evaluations, write your questions that you want answered on GYF Tax Talk Day on December 9th, and I'll try to squeeze them in if I can. Thank you so much. I'm only a minute over. That's a home run for me. Have a great day. Thank you.